Welcome to the research desk.
Glad to be here.
So, I want to start with a question today. What is news actually worth before everyone else knows it?
That is the ultimate timing problem, isn't it?
Exactly. It's a pure timing problem. And I am taking the position today that Reuters built the ultimate enduring infrastructure monopoly out of thin air just by owning the pipe that solved that timing problem.
Well, and I am here to argue the exact opposite, because I think Reuters actually proves why building a business purely on moving information is, it's a doomed model, because speed always commoditizes.
I mean, we are going to examine a business that did not begin as a newspaper. It didn't begin as a newsroom. It didn't begin as some grand journalistic institution.
Right, it was practically a math equation.
Yes, it began as a mathematical equation of time. To understand how a company can build a financial flywheel out of thin air, we really have to go back to the middle of the 19th century.
The 1850s specifically.
Exactly. Europe was wiring itself together, but the new telegraph network was profoundly uneven. It had massive geographical gaps.
It wasn't just a seamless web.
Not at all. Information could travel at the speed of electricity along one line, and then suddenly it would just decelerate. It would slow back down to the speed of trains or horses or ships or even human messengers, where the copper wires physically ended.
And the immense financial value of that era was hidden entirely in the seam between those two speeds.
Yes.
We are looking at a story that is captivating because it appears to be a triumph of raw velocity. But, history demands a rigorous stress test of that assumption, which is what we are here to do.
Right. Because whenever a business relies entirely on moving information from point A to point B, it leaves itself fundamentally vulnerable to the interface.
You mean the user interface, the desk?
Exactly. We are going to dissect how a company can invent the electronic distribution of facts, completely dominate an era of scarcity, and still find itself completely outflanked when the market transitions.
Transitions from demanding raw data to demanding an embedded workflow?
You nailed it.
So let us look closely at the very first seam in that 19th century network. The year is 1850. A man named Paul Julius Reuter is operating out of Aachen, Germany.
Right in the middle of a massive infrastructure build-out.
Correct. The telegraph is essentially the internet of the 1850s, but it does not create a ubiquitous network overnight. Instead, it creates isolated islands of electronic speed. And these islands are separated by what we can call old world gaps.
Yes, old world gaps. And the most critical gap of this specific period was the missing circuit between Aachen, which connected eastward toward the financial hub of Berlin, and Brussels, which connected southward toward the financial hub of Paris.
The geography here is really crucial. I mean, why was there a gap in the first place?
It was terrain and politics mostly.
Right. Telegraph lines in the 19th century generally followed the railway lines. They used the railway right-of-ways to lay the physical poles and wires.
That makes sense. The land was already cleared.
Exactly. But the terrain between Aachen and Brussels was politically and geographically complicated, meaning the railway and therefore the telegraph wire was simply unfinished.
It was a physical dead zone.
Yes, a dead zone of about 76 miles. If you wanted to send a message from Paris to Berlin, it shot up to Brussels at the speed of light, stopped cold, was printed out, put on a train to Aachen, and then retransmitted via telegraph to Berlin.
And most people observing that 76-mile dead zone saw a simple communications failure. They just saw a frustrating delay.
But Reuter didn't.
No, he did not. Reuter looked at that exact same delay and saw a business model. He recognized that the delayed connection between two major financial hubs was a temporary inefficiency that could be monetized.
And his solution was, honestly, incredibly analog.
To bridge that gap, he deployed a fleet of carrier pigeons.
Pigeons.
Pigeons. He eventually grew this fleet to more than 200 birds, and he used them to bridge the gap between the Belgian and German telegraph networks. These birds carried stock prices and news across the missing link.
I mean, it sounds almost comic to a modern sensibility to think of birds acting as market infrastructure.
It does. It really does. But the business logic driving this was absolutely ruthless. This is the purest, most mechanical definition of latency arbitrage.
Let us break down exactly how latency arbitrage works in this context because it's fascinating.
Okay, so if I am a banker sitting in Berlin in 1850, and I receive the Paris stock market closing prices 2 hours before the rest of the market receives them, I am not just reading the news.
You are looking at a time machine.
A 2-hour time machine. I know exactly how the market has already moved. I can actively buy stocks in Berlin that I know for a factual certainty are currently underpriced.
Because the rest of the market is still waiting for the train from Brussels to arrive.
Exactly. It's basically a license to print money.
It really is.
A stock price from Paris arriving in Berlin 2 hours early is hard money. A diplomatic dispatch arriving before a rival newspaper can print it is reputational dominance.
Reuters capitalized on the blind spot of his era perfectly.
He understood that when networks are incomplete, the actor who bridges the gap captures immense, immediate value. The pigeons were flying past the train carrying the mail. That speed differential was the entire product.
I agree, but we must not romanticize the pigeons.
What do you mean?
The product being sold in 1850 was never the bird. The product was continuity. Reuter was fundamentally patching a broken API in the 19th century hardware stack.
Oh, that is a great way to frame it. A biological API.
Think about how modern software works. When two distinct software systems cannot talk to each other, a developer builds an application programming interface, an API, to translate and move data between them.
And Reuters pigeons were the translation layer?
Precisely. When networks are incomplete, whoever bridges the physical or digital gap commands a temporary monopoly on value. But the key word in that sentence is temporary.
So you think the business model was inherently flawed from the start?
I think businesses constantly mistake their current technological patch for a durable, long-term moat. But Reuter was exceptionally rare because he did not suffer from that delusion.
He knew the birds wouldn't last?
He understood that his avian infrastructure was doomed the exact moment the terrestrial wire was finally laid to connect those two cities. He knew the gap would eventually close.
Because the market always closes the gap.
Always. If you build a business model entirely predicated on an inefficiency, your business faces an existential crisis the moment the market becomes efficient.
Right. What happens to your company the day a copper wire renders your entire biological fleet obsolete?
You pivot, and that is the ultimate test of a founder.
Which brings us to 1851. Reuter bridged the Aachen-Brussels gap, captured the initial latency arbitrage, but then had to figure out what to do when the physical wire closed the seam.
And his response was a masterstroke strategic pivot.
He survived by industrializing the pipe itself. In 1851, the wire between Aachen and Brussels was finally completed. The pigeon operation was instantly worthless.
So he packed up.
He completely abandoned Germany. He relocated to the absolute financial heart of the global economy, London.
But he didn't just move to London generally. The specific coordinates of his new office dictate the entire future of the business.
Yes, this is my favorite detail. With the help of an 11-year-old office boy, he opened his operation at One Royal Exchange Buildings.
We really need to pause and examine the exact physical geography of that decision.
He placed his business exactly where infrastructure, markets, and capital physically intersected.
It was the 19th century equivalent of putting your server farm next to the Wall Street Exchange.
Exactly. If you walked out the front door of One Royal Exchange Buildings, you were steps away from the main telegraph offices. You were steps away from the Royal Exchange where the merchants and traders gathered.
He positioned himself perfectly to exploit a brand new piece of technology.
The Dover-Calais submarine telegraph cable.
And the submarine cable is the moment the game fundamentally changes. Moving information over land is one thing. You put poles in the dirt.
Right, it's pretty straightforward.
But crossing the English Channel with a copper wire insulated in gutta-percha sap is an entirely different level of capital expenditure and technological risk.
And that cable directly connected the island of Britain to continental Europe for the very first time.
Through that underwater route, Reuters began transmitting stock market quotations and news between London and Paris.
He was no longer running a makeshift patch over a broken network. He was sitting at the most valuable choke point of global commerce.
London was the capital of global finance, and he was the gatekeeper of the wire connecting it to the continent.
This is where we see the absolute genius of the non-rivalrous subscription machine emerge. Reuters realized that news can be sold more than once.
We need to explain the mechanics of a non-rivalrous good here. It is the foundation of the modern information economy.
Let's do it. If I sell you a physical commodity, let us say a barrel of oil or a physical newspaper, I lose that inventory.
Right, I have it and you don't.
Exactly. I can only sell that specific barrel of oil once. My possession of it is rivalrous to your possession of it. But if I sell you information, the economics are entirely different.
The marginal cost of copying data is practically zero.
Yes, zero. However, the fixed cost of initially collecting that data, hiring a correspondent in Paris, leasing time on the Dover-Calais submarine cable, paying telegraph operators, is astronomical.
It's a massive barrier to entry.
So Reuters gathered, standardized, and transmitted the same core stream of verified information to a massive overlapping client base.
And crucially, that client base did not fully compete with one another.
Precisely. A newspaper bought the Reuters feed for breadth of coverage to entertain its readers,
While a banker bought the exact same feed for stock quotations to price financial risk.
and a government bought the service for geopolitical visibility to track foreign navies and diplomatic maneuvers.
Each distinct customer paid a subscription fee.
Those combined subscriptions financed a wider, faster, more robust network. That expansion made the underlying service infinitely more valuable for everyone else.
It's the ultimate network effect.
If the banks fund the expansion of the wire to Vienna, the newspapers get the news from Vienna basically for free. It is a perfect, self-reinforcing financial flywheel built entirely out of wire and timing.
I hear the bull case, and we can acknowledge the brilliance of the shared infrastructure model, but we also have to recognize the historical reality of how these networks are actually sustained.
What do you mean?
We can draw a direct line between Reuters, the Rothschilds, and Lloyd's of London.
Okay, explain that connection.
The Rothschild family built a proprietary network of private speed strictly for their own sovereign finance and trading advantage. They used private couriers and their own fast ships.
Right, a closed loop.
And Lloyd's built a physical room, a coffee house, where maritime risk information could concentrate and be transformed into pricing data for shipping insurance.
So Reuters democratized that speed.
Yes, he built a commercial pipe so that every other institution did not have to absorb the staggering capital expenditure of building their own global intelligence network. You could just rent his.
That is the ultimate value proposition of an infrastructure monopoly. You provide a utility so vital and so expensive to replicate that the entire market simply chooses to rent it from you.
However, I have to push back on the framing of this as a romantic, frictionless free market triumph.
It wasn't frictionless.
The economics of global networks are structurally brutal. Maintaining overseas correspondence, leasing submarine cables, operating international offices, these fixed costs are terrifying.
So how did they survive the expansion?
The reality is that Reuters did not survive this global expansion phase through pure competitive superiority or magical flywheel. It survived by forming cartel-like, oligopolistic alliances with its major European rivals.
You were referring to the ring combination.
Yes. Reuters looked at the staggering costs of wiring the globe and realized that competing on infrastructure would bankrupt everyone.
So he teamed up.
He allied with the French news agency Havas and the German news agency Wolf. From the late 19th century onward, these three entities actively colluded to divide the global map into exclusive coverage territories.
They literally carved up the world.
They formed a cartel. Havas took France, South America, and parts of Southern Europe. Wolf took Germany, Scandinavia, and Russia. Reuters took the British Empire, North America, and the Far East.
And they just swapped data?
They exchanged news seamlessly among themselves, specifically to crush the fixed costs of global reporting and prevent ruinous competition.
Which makes perfect business sense. It is the rational optimization of global infrastructure.
It is rational, but it is also a monopoly. And we also cannot ignore the profound imperial entanglement of this operation.
You mean the connection to the British Empire?
Exactly. As Reuters expanded globally, it became deeply intertwined with the British Empire's communication architecture. The agency was not merely holding up a neutral, objective mirror to the world.
It was actively structuring what parts of the globe the London financial markets could see.
And through London, it dictated what the rest of the world could perceive. When you own the sole infrastructure of global visibility, you wield a terrifying degree of geopolitical power. You are not just moving facts, you are shaping reality.
Which brings us to the fundamental vulnerability of that exact power.
Go on.
When you wield that degree of geopolitical influence, and when your infrastructure dictates the movement of capital and the deployment of armies, the integrity of the data becomes the only thing that matters.
The accuracy has to be bulletproof.
Once the physical network was built out and global reach was established through those alliances, the primary problem for Reuters shifted. The problem was no longer about establishing the connection, it was about protecting the network from itself.
Because if everyone on the network is receiving the news at the exact same blinding speed, how do you prevent the entire system from collapsing the moment bad data is introduced?
Exactly. I mean, imagine the catastrophic consequences of a wire service transmitting a fabricated war report at the speed of light.
It would be chaos.
Complete chaos. Let us say a false report claims a British naval fleet was destroyed. Clients execute trades instantly based on that. Newspapers publish massive panic-inducing headlines instantly.
And if that information is false?
Those clients suffer devastating losses in capital. The newspapers suffer a massive loss of institutional reputation. Reuter understood early on that speed without trust is not a premium product. Speed without trust is a massive structural liability.
A faster falsehood fundamentally destroys the utility of the pipe.
If a trader has to pause and verify your price quotation through a secondary channel, your speed advantage mathematically drops to zero.
Because they aren't saving any time anymore.
Right. This realization culminated fundamentally in the 1941 creation of the Reuters Trust Principles.
We really need to look at the timeline there. It is 1941, the middle of World War II. London is under heavy bombardment. The British government is heavily incentivized to use every tool at its disposal for wartime propaganda.
There is immense pressure on the Reuters news pipe to basically serve the state.
Yes, and in response to that pressure, Reuters formalized 4 unshakable pillars to legally and structurally insulate its data feed.
Let us break down those 4 pillars because they act as the operating system for the entire network.
First, speed, which makes the service commercially valuable to traders. Second, accuracy, which makes it practically usable for decision-making.
Third, integrity, which makes the client behavior repeatable.
And fourth, impartiality. Impartiality is the absolute genius mechanism here.
Why is that the genius part? Because impartiality allows you to sell the exact same information feed to fiercely competing factions. You can sell it to hostile governments. You can sell it to rival financial institutions.
Right, because neither side thinks it's tainted.
Exactly. Later, the company even created the Reuters Founders Share Company, which was a unique corporate structure designed strictly to protect this independence from corporate or political interference.
Now, many modern analysts dismiss corporate governance as just ornamental public relations.
They are entirely wrong. For an information infrastructure business, trust is the distribution infrastructure. Trust lowers the cognitive and financial cost for a client to act on the data.
That is a critical point.
When a trader sees a Reuters quote, they do not hesitate. They do not run a background check on the correspondent. They execute the trade. That lack of hesitation is what Reuters is actually selling.
The trust principles were not a sudden awakening of journalistic morality. They were an absolute market necessity.
A survival mechanism.
Trust was a survival mechanism in a world where the speed of transmission had permanently outpaced the speed of human verification.
And that principle holds perfectly true today.
It holds true, but the environment has inverted.
How so?
We see the exact same crisis playing out today across modern social media feeds and AI-generated content platforms.
Sure, the sludge of AI content.
The internet created an era of absolute distribution abundance. The telegraph was defined by scarcity.
Right, laying a cable was incredibly hard and expensive.
But the internet completely annihilated the scarcity of the wire. Today, everyone has a printing press in their pocket. Everyone has a global distribution feed.
And when distribution is completely democratized,
The commercial value of raw transmission plummets to zero.
Exactly. But Reuters managed to survive the internet revolution. That is an event that completely destroyed thousands of legacy media businesses.
They survived specifically because they had already spent a century migrating their core moat.
They had already shifted their value proposition from exclusive speed to unshakable institutional trust.
They recognized that in a high-noise environment, a verified signal commands a massive premium.
I agree that the pivot toward trust protected their news and geopolitical reporting flank. But a completely different threat was incubating out in the financial markets.
A threat to the pipe itself?
Yes. It was a threat that would completely redefine what the value of an information pipe actually is. Because while Reuters was perfecting the trustworthiness of the feed, the customers were changing how they wanted to interact with the data.
Before we get into that vulnerability, we have to look at the sheer scale of the financial infrastructure Reuters built, just to understand how deep their market penetration went.
Fair enough. Let's lay out the timeline.
For decades, Reuters executed a relentless, masterful technology migration to stay ahead of the commoditization curve. They refused to remain static.
They didn't just sit on the telegraph.
Right. When carrier pigeons became obsolete, they dominated the submarine cables. When the cables became standard, they moved to computers. In the 1960s, they revolutionized the market by transmitting computer-generated stock quotations directly to screens.
They took the physical ticker tape and digitized it.
Yes, and they did not stop there. In 1973, they launched the Monitor Money Rate service,
Which was massive.
It effectively created the first electronic foreign exchange marketplace. Before Monitor, foreign exchange was done by shouting over telephones.
Reuters put the rates on a screen.
In the 1980s, they pushed even further with the Monitor dealing service. This allowed foreign currency dealers to actually conclude trades over video terminals. They combined the information feed with the execution venue.
Moving closer to the actual transaction?
And by 2006, they were pioneering machine-readable news products designed specifically for algorithmic and automated trading systems. They stripped the human out of the loop entirely.
The progression is undeniable. They consistently built the fastest pipe for the newest era.
And look at the immense corporate valuations this infrastructure generated. It proves the enduring, compounding value of the pipe model.
Let's talk about the numbers.
In 2008, the Thomson Corporation and Reuters Group merged in a massive consolidation of financial data power.
The birth of Thomson Reuters.
Then, in 2018, they carved out and sold a 55% stake in their financial and risk business, which they rebranded as Refinitiv, to Blackstone for a staggering $20 billion.
$20 billion for slightly more than half the company.
And a year later, the London Stock Exchange Group acquired Refinitiv in a transaction valued at approximately $27 billion.
That is an astronomical figure.
The United States Department of Justice literally described Refinitiv as a major provider of financial markets data and infrastructure. That $27 billion valuation is the ultimate vindication of the infrastructure model.
It's hard to argue with $27 billion.
It proves that owning the critical data feeds, the benchmarks, and the execution venues is one of the most lucrative business models in modern capitalist history.
A $27 billion valuation is undeniably massive. No one is debating the absolute financial scale of the achievement, but we have to look at the broader context of the financial data ecosystem to see the vulnerability that was exposed during this exact same timeline.
What vulnerability?
Bloomberg won the ideological war.
I completely disagree that Bloomberg's success makes the Reuters pipe useless. A $27 billion valuation proves that owning the underlying nervous system is still fundamentally more valuable than anything else.
Let us break down exactly what happened, because the nervous system changed. By the late 20th century, the definition of speed in the financial markets underwent a fundamental mutation.
How did the definition change?
While in 1850 a trader defined speed simply as a price arriving a fraction of a second before a rival's price. But by 1990, speed had transformed into workflow.
Workflow?
Yes, a trader sitting at a desk did not just want a raw, blazing fast price feed scrolling down a monitor. They wanted the price, yes, but they also wanted historical charting to analyze the trend.
And portfolio analytics?
Exactly. They wanted portfolio analytics to calculate risk. They wanted instantaneous messaging with other market participants to gauge sentiment. They wanted direct execution links to buy the asset, and they wanted seamless Excel integration to model the outcome.
And they wanted all of this unified within a single, inescapable digital environment.
You are describing the Bloomberg terminal.
Or as you called it, the Bloomberg wall.
The Bloomberg wall. Reuters had spent decades building and perfecting the underlying pipe, but Bloomberg built the desk.
And the desk is where the human sits.
It is genuinely staggering to consider that Reuters, the company that literally invented the electronic distribution of financial data, the company that had a century-long head start in market dominance, allowed a competitor to capture the daily, minute-by-minute habit of the modern trader.
Well, to be fair, Reuters still provided the feeds that powered much of the global system.
They did. But Michael Bloomberg understood a brutal truth that Reuters missed. Having the fastest data feed in the world is utterly useless if someone else owns the interface where the human being makes the decision.
You're talking about the messaging system.
Yes, Bloomberg's proprietary messaging system, Instant Bloomberg, or IB, created a workflow lock-in that raw data could never achieve.
If all your counterparties are on IB chat, you cannot switch your terminal.
Even if a rival offers a faster data feed. The trader practically lived inside the terminal. Reuters treated the market as a distribution problem. Bloomberg treated it as a behavioral ecosystem.
So the pipe becomes commoditized by the application layer?
This proves that an infrastructure business cannot survive long-term purely by moving facts. You must capture the workflow.
That historical vulnerability is exactly why we need to map the Reuters trajectory onto the modern technology landscape.
It maps perfectly.
The evolution from the Aachen pigeon route to the Bloomberg terminal reveals a universal 5-step pattern. This pattern dictates the life cycle of all modern information monopolies.
Walk me through the 5 steps.
Step 1. Identify a high-stakes decision that is fundamentally constrained by delayed information.
Like the Aachen-Brussels gap?
Step 2. Build the lowest friction, highest speed channel directly into that decision environment. Step 3. Monetize the pipe by selling recurring subscription-based access to the data stream.
Which is the non-rivalrous subscription model.
Step 4. Institutionalize trust so that your feed becomes the undisputed system of record. And step 5. Migrate your technology up the stack before the underlying pipe becomes commoditized.
This is where history perfectly overlaps with the present. That 5-step playbook is driving the massive valuations of today's API and infrastructure giants.
Think about Stripe. What was the gap Stripe bridged?
Accepting payments online used to be a nightmare.
It was the gap between 7 lines of developer code and the archaic, fragmented legacy banking system. Stripe is essentially the modern submarine cable for global payments. It normalizes the fragmented infrastructure and provides a seamless, high-speed pipe for capital.
And Plaid does the same for banking data.
Yes, think about Plaid. Plaid bridges the gap between consumer financial applications and legacy bank mainframes. It is a data pipe.
Same for server data.
Think about Cloudflare for internet security, or Datadog for system observability, or Snowflake for massive-scale data warehousing.
None of them manufacture the end product.
They don't. They gather, normalize, and distribute the critical information required for modern commerce to function. They are operating entirely in the background. They are perfectly frictionless.
Just moving the data?
They capture immense, recurring value simply by being the indispensable channel. They are the new infrastructure.
The parallel is accurate, but it brings us right back to the fatal flaw of the Reuters model. Data feeds, no matter how fast or how clean, are infinitely easier to replace than embedded workflows.
You think Snowflake could be replaced easily?
If Datadog or Snowflake restrict their ambitions to acting merely as passive repositories or raw data pipes, they are entirely exposed. Eventually, a cheaper, faster, or more efficient open-source pipe will emerge. The market always commoditizes raw transmission.
But these modern companies are actively building analytical tools on top of their data. They are not just passive pipes.
Because they are trying to avoid the Bloomberg wall. The profound lesson of the Reuters and Bloomberg war is that the distinction between owning a pipe and owning a nervous system comes down entirely to embedded workflow.
You have to move up the stack.
You absolutely have to move up the software stack into decision support. The first company to bridge a technological or informational gap will undeniably capture the initial market value.
We saw it with the pigeons.
We saw it with the submarine cables. But the market inevitably closes that gap.
When the infrastructure becomes ubiquitous, the premium shifts from the transmission of data to the interpretation of data.
So the interface becomes the new moat.
If your software does not become the definitive interface where the developer, the financial officer, or the analyst actually makes their daily decisions, you will be swapped out for a cheaper utility.
I hear what you are arguing regarding the workflow, but I cannot concede that the pipe itself loses its fundamental value. The pipe is the prerequisite for the workflow.
You need data to make a decision, yes?
You cannot build a Bloomberg terminal without the data flowing into it. Reuters provided a masterclass in recognizing an invisible seam in a new technology. They relentlessly built an empire out of a timing discrepancy.
They did build an empire, I agree.
They proved that standardizing and distributing trust at scale is one of the most powerful business models ever conceived. Yet their later battles clearly demonstrate the relentless pressure on infrastructure businesses.
You cannot stand still.
The moment you optimize the pipe, the customer's expectation shifts to the application layer.
The history is clear, but the forward-looking implication is what every modern founder and investor must grapple with today. We have to look past the romance of the initial innovation and look at the brutal reality of market maturity.
What's the ultimate question they should be asking?
When your customers no longer need your pipe to get the facts, do they still need you to make the decision?
This is the research desk officially signing off.